Hi guys, I'm back and today we're going to talk about another stock I own since March of this year, and this is Verizon. You probably heard about this company. This company is pretty huge. They provide different telecommunication services, also communication technology, information products, different services to consumers, mostly in the United States, but also in some other countries. So I would say also worldwide. They are pretty big, and like I said, I bought shares in this company in March of this year with the price $57.20 for a share. This is my biggest position among all of my stocks, because I really like this stock, and in a minute I explain you why. So like I said, I bought it here, and according to my valuation, I think the fair price or intrinsic value for this stock would be something between $63 and $64. And yes, the margin of safety for this stock, or 10% discount for this stock, would be $58, and I bought it here. I already did some profit, but right now I'm having a small minus, but it's okay for this stock and volatility in the market. That's absolutely okay, because this is a value stock. This stock has a lot of value, and I'm considering this stock as a long-term investment, so I'm going to keep it. So I would start with basics like always. I'm gonna to show you some past performance of this stock, so you understand why the stock is great. So the revenue of this company is, I would say, pretty constant. It's not growing too fast, but it's also not going down. And what I like about this stock, Verizon can generate pretty good cash flow. The yellow line right here, this indicates cash flow from their operations. So cash flow is bigger than earnings. That's what I'm looking in stocks, really. And also free cash flow, it was great all the time, especially beginning from 2018. Free cash flow is growing. Sadly, in this year, in 2021, they invested a lot of money. I'm gonna show you right now in what they invested. You can see it here. From free cash flow in 2021, they have a minus because they invested a lot of money in capital expenditure. So you can see here it's with a huge minus. Before it was like 20 millions, and this time was big. It was 3 times bigger than before. So it means they had this huge capital expenditure for something. I'm not sure for what, but you can see here it's 3 times bigger than in previous year. So this is absolutely okay, because operation flow from this company is growing. You can see it here. So it's beautiful. So one time they decided to invest huge amount of money in expenditure. Honestly, I don't care, because operation cash flow is strong, and what they do with their free cash flow, it's up to them. So for me, it's important they are able to pay dividends, and they do. So from this, you see a dividend paid. So it means that company pays constant dividends. Also in this year, in 2021, also in the year 2020, although the time was not good because of the coronavirus crisis. So they still pay dividends, and that's what I like about this company. They pay stable dividends. You can see here they are a 6-star dividend payer, and right here in this area you can see it's 6 stars. They pay 4.38% dividend yield. So it's pretty big, and from here you can see it's stable. 10 years straight without any interruptions, without any break. So, and they pay only 55% of their cash flow for dividends. So it's pretty good. It's not higher than 60, and I would not go for a stock who pays 80 or 85% of the cash flow for dividends, because it's a bit risky. But in case with Verizon, they only pay 55%. It would be better, sure, if they paid only 30%, but 55 is still okay for me. So I like this company first because they pay dividend. Like I said, that's nice. They pay a lot of dividend. Second, they have some value. So I was showing you this chart. From this chart, you can see the company is stable. It's not growing that fast, but revenue is stable and cash flow is beautiful. The only one thing, what I don't like of this company, they have too much of debt. So from this chart, you can see it's 217%. But the good thing, they decrease this number from 550 to 217. So this is a good thing about this company. They had this huge amount of debt, and they decrease it during 5 years. Right now it's high, but I'm not worried because their operation cash flow is fine. It's bigger than 20, so it means they can cover their debt easily, and also they have some cash flow on hand. It's not much, but still, it's a couple of billions. It's 10 billions. Well, like I said, their operation cash flow is stable, and they're able to cover their debt. Ownership of this company, you can see here below. So there are big players invested in this company, like the Vanguard Group and BlackRock. They have 8% shares ownership in this company, and they are those are some buys in recent months. You can see here 10%, here 3%, here 8%, and also some sales, 20%, also 7%. But from what I'm seeing here, I see more buys than sells. So it gives me the hope that other companies also seeing potential in Verizon. So that's why they invest. This was the short introduction of this company, and I'm willing to show you some more information. So on this website you can see the revenue. It's basically the same what you saw here, but you can see also here year-to-year quarterly growth. So for this company, the revenue is stable, is very solid, and also here you can see that the company is growing with their quarterly growth. It's not too much, but like 5%, sometimes 2%. Was minus in 2017, sorry, but it was only 1 or 2 year. So most of the time we see some small year-to-year quarterly growth for this company, and I really like it. and like in the previous quarter you have a +4 year-to-year quarterly growth, plus the revenue is stable. That's beautiful. So the next would be earning per share for Verizon, and they started low in 2010 from $1, $2, and right now they're like at $4.80. You can see it here, and the biggest earning per share was almost $8. That's pretty big, I would say. So this is also good. And Verizon PE ratio, so its price to earnings ratio, it's quite low. It's right now at 12, and the lowest was like 6 or 7. And using this website you can see that the lowest one was 6 indeed, and the medium was 15. So right now we are between lowest and medium. It's a 12. The medium PE ratio would be 20. So for this stock, for Verizon, it could grow easily to 15 and maybe to 20 in their PE ratio. So it's also nice. Last but not least, I would like to show you some other metrics, but using this website Morningstar. The second thing I like about Verizon is that their gross margin is growing. So they started with 58 and right now it's 59, so it's not going down. It's growing a little every year. So even better operation margin. They started with 11 and right now it's 23, so they doubled it. I really like those numbers because that's exactly what I'm looking in a company before I buy. I look for stable gross margin and also stable operation margin. Okay, in this case, it's even better. It's increasing, so it's really nice. And Verizon also pays a lot of taxes, so it's 20% here, 20% here. They pay almost every year constant tax rate, so I'm not afraid that their net margin is going to decrease because they pay tax, they pay the constant tax rate. So I'm not afraid that net margin is going to decrease dramatically. Return on asset is okay. It's not that great as it was here in 12, but I can live with 6. Return on investment capital, good as well, 10. That's a good number. Like I said, financial health, they have some debt, but they trying to decrease it, so that's why it's okay. Current ratio is 1, a quick ratio is almost 1, that's also fine. Like I showed you before, earning per share is also increasing from $1 and then $2, $3, $7, and they back to $5. So you can see that earning per share is also increasing, revenue is increasing, or at least it's stable since 2018. So that would be it for the financial situation of this company. For your information, I have another company, a very similar company to this one. It's a Swisscom. It's also a telecommunication company, but it's located in Switzerland, and they provide services for Switzerland, Italy, and also internationally. I own both companies. Both pay dividends, and they are both 6-star dividend payers. So Swisscom, what I like about this company, it's also very stable. I'm going to show you some past performance of this company. Their revenue is also stable, like it's something similar you saw here, though you can see they have something in common, a stable revenue. So cash flow is also very stable here, and it's similar to cash flow in Verizon. and also free cash flow is very strong here. You can see it's very similar to Verizon, I have to say, except of this last quarter. But in general, you can see that those companies are not that fast growing in their revenue. It's not like Uber or Amazon. Those are value companies, and you have to be patient to get some profit from this company. You're getting profit from this company if you hold the stock for long term. In this case, you get dividend and growth. So you have to be patient with those stocks. It's not like you bought it yesterday and tomorrow you're gonna be a millionaire. No, it's nothing like that. You have to hold the stock for a couple of years, and that's what I'm going to do with Verizon and also with Swisscom. Financial health of Swisscom is even better. They have a less debt, but the company is also not that big as Verizon. They have only 25 billions. Like I said, Swisscom also pays a dividend. They have some good management team, like Verizon does. So the charts for Swisscom would be this one. So I bought it here with the price 508 Swiss francs. That's a currency in Switzerland. So 508 Swiss francs is approximately $560 for a share. It's expensive. You might think it's expensive, but the number of outstanding shares for this company, for Swisscom, is less than in Verizon. It's only 52 millions, and in Verizon you can see it's 4 billion. So it's 4.1 billion. So those are very similar stocks. They provide similar services, and they both pay dividend. One more time, I say it again. With those stocks, you have to be patient and hold those stocks for long term, because they pay dividend and they grow, but the growth is very slow. That would be it for telecommunication sector. Like I said, I own both businesses. I like them, and I'm going to keep them for long term. Thank you for your attention, guys, and see you next time. By the way, if you like the video, give me please a thumbs up and subscribe.